I've saved, once again, $4 or $5 million in assets. I'm in a good spot. My biggest fear is, what if it means nothing? Is the US dollar changing? Is currency in and of itself changing? And if it is, what does that mean to individuals that are trying to literally make the final steps toward retirement? So a few weeks ago, you kind of posed a question, I believe it's one of our podcast shows, and you asked the question about what's the new million? Essentially was the question.
Yeah.
And my response was, in some sense it's off the hip, right? Because we basically are doing this, live to take, if you will. I guess is what they call it. And so, it's for the most part relatively unscripted. And, I made this statement, maybe if I had to put a number out there, 2 million, 3 million, might be the new million.
Right.
And that's kind of a reference back to like, so many people know Dave Ramsey, his organization, his mission to guide people in making wise, solid financial decisions, not outspending their lifestyle. And he used the term frequently of the everyday millionaire.
Yes.
I believe there was even maybe a book.
Oh, yeah.
Titled The Everyday Millionaire. And so, it was kind of a play off that, which is, what is the new million? And the reality is there's actually a lot of factors that go into that. And I think what I would like to do, and see if we can't just maybe, it may not be just this week, it may be over the next few shows that we do, is really try to consider how do you actually quantify what the new million is. Because when you look at the U.S. dollar, there's a lot of elements at play that factor the value and the spending power of the U.S. dollar. Mm-hmm. Obviously, over the last decade, and maybe even the recent 5 to 7 years, we're talking just substantial change in policy, in monetary policy, in politics, international relations, trade. There's just so much that goes into what is supporting or depreciating the value of our U.S. dollar.
Yeah.
So, what's your thoughts? And let's just dive in. 2-3 minutes. Like, what is it, and what really matters, and why does it even matter to the type of clients that we serve, the ones that are maybe getting close to retirement or in retirement, or the business owner that's trying to, why does it even matter anyway?
Yeah, that's a good question, and I think everyone should be asking themselves that question. Is what's the number that I'm trying to reach? What does that really equate to, not just today, but in relation to my future down the road? Because I feel like that number, $1 million, is a nice round number that has been really embedded in our heads, as far as this peak, this real threshold that one should strive for. And maybe those numbers back in 1970, 1980, whatever, you go back 40 years, maybe that $1 million number was really that gold standard. If you got to that number, then you made it. Mm-hmm. Lifestyle wasn't at it relative to today, right? Maybe $1 million could support that lifestyle. But when you just look at today's world, where just a few years ago, I'm not talking decades, a few years ago, where inflation was rampant.
Yeah.
Right? And
historical.
I mean, there was that, I made jokes about it when we did our workshops, but people were freaking out about the price of eggs and freaking out about the price of bacon.
Yeah.
Because it was, $10 a pound, but eggs were $10 for 12. I mean, lifestyle to keep the same lifestyle that most people had, inflation really eroded it. Mm-hmm. And then up until 2017, when the tax laws changed, taxes were really, really hampering people. And so I think for now, we need to ask ourselves, what is that true number? Where does $1 million, how does $1 million actually play in someone's retirement lifestyle? Because prices of almost everything is going up. Mm-hmm. And not just in your normal groceries, but your day-to-day insurances, your day-to-day electricity bill, utilities, just the things that to keep your lifestyle afloat. Those are going up at rapid paces too. So I think it's a really good question to pose both sides, those that are accumulating, Because if they don't really have a great understanding of what number they actually need to get to, then they may be chasing the wrong number. And while they're working and saving and in their prime earning years, if they don't have that, at least a clear understanding of what they should be striving for, they can get to retirement and be out of luck because, they're not earning, they're taking money. And those that are retired, taking distributions and setting their life on this asset level, then if they don't really know what the $1 million is or don't know what that true number is, that really impacts their decision making on where they take their assets or where they take their income from. It makes a decision on how they invest. It definitely impacts, how they spend. How they spend, where they take money from, how they invest, all plays a big factor of that number. And if you don't know what that number is, you kind of set yourself up.
Yeah, no, and it's almost like, to your point, it's the measuring stick has changed, and it does. So it's people. I think if people slow down and at least the conversations that we have with everyday individuals that have ideally made it to a place where they can live financially free. Ultimately, meaning they, don't have to constantly trade their time and energy for money. If you ask them the question, really, they do have a measuring stick to the number in which they're trying to save toward. They just may not have the best way of articulating it. So, like as an example, when someone says, "Hey, I really need to. I'm trying to get to $2 million in assets. I'm trying to get to $5 million in assets," and you begin to dissect why. Okay. Typically, they can talk about the lifestyle. Well, when they envision a lifestyle, they envision the cost of that lifestyle and the lifestyle they want to have. They think about, because actually, right now it costs me around, $7,000, $10,000 a month to live my life, and I'm not doing some things that I want to do when I retire. So I want to be able to go on vacation and travel. And so, let's say there's another $15,000 to $20,000 that's going to, jump into a travel budget. Maybe I want to be a member, and so, in some sense, they do have a measure to the amount that they want to save toward. The problem that we're posing, and the reason the old everyday millionaire is not the same as today's everyday millionaire, is the measuring stick has changed. And to many of the points that you made, we literally have diluted, in some sense with monetary policy, the value of our currency. It's no different than you think about like injecting more money into the market, just like trying to, take my cup of coffee here and pour more water into it. Okay. Yes, the balance or the level in which or the volume of my coffee is going to rise up, but definitely the value of it has been
diluted,
reduced, and diluted. And so yeah, all this matters. And so let's talk about it. The one other point that I think we should reference though is what also has reduced the value of our money is also our own choices in lifestyle. I think because you made a statement about like going back to like 70s, 80s, right? I was thinking, back when I was a kid, Pops was not taking me to no travel sports. You know what I mean? Like he is not traveling. I mean, first off, we had a station wagon with like the ceiling felt, I guess, like hanging down. That's funny.
Man.
And I remember telling my mom, I'm like, I got this. I can fix it. Old beaver panel going around the station wagon, right? I thought had a back row seat facing the other way.
Oh, yeah. I remember those.
Oh, those are slick.
Yeah.
So I took I took a staple gun and was like, I'm going to fix this because it like had given loose from the roof. And I'm like, knocking the staples in it. Like it was awful. It was my best attempt.
Yeah, it will say, yeah. It was a valiant effort. Yeah.
Yeah. But we weren't traveling all over the place. Eating out was not even like just didn't happen.
Yeah, same here for me.
So
yeah, same here for me. It's it's the danger of the lifestyle creep where, as our income increases, as our assets increase, there tends to be a level of, well, my lifestyle needs to adjust to that income, and so or that asset level. And you can end up being in a trap where it's like sometimes you may not feel like you're making any advances, right? Because you're always playing catch up to that income so you're making good income, but your lifestyle continues going up. I think I heard gosh, I think it was Dave Ramsey. I heard someone say, act your wage. You know, when people say act your age, they were like, act your wage. So I thought that's pretty cool. But yeah, no, one thing that you're right. I mean, that lifestyle creep can really, really play a good impact. I mean, even just that example that you made earlier of an individual who, says they need currently right now $7,000-8,000 to run their lifestyle, but they want to add a little more perks to their life once they hit that certain milestone, whether it's retirement, not necessarily an asset level, but like when they hit retirement for so. And so now all of a sudden they're adding more stuff. Right, they're just adding more stuff to their lifestyle, and it's fine if you've done the right planning behind it, and your financial plan can justify and support that lifestyle. But it doesn't. But what I would warn those who are listening is pay attention. Really do pay attention to how much you are continuing to add to that budget, to that spreadsheet on the expense side versus on the outflow side, because if there's not enough to support it, then again, you may find yourself in a situation where 10, 15 years down the road, all the fun, all the decisions that you made in the first stages of your retirement can backfire on you. So yeah, I mean, the lifestyle creep is something that is huge, not just for retirees, for those that are saving for retirement. At least for them, they're still in their earning years, they're still in their saving years, so maybe they can, kind of support it and either invest harder, save more. But when you're retired and you're transitioning from income from your time and energy to income from your assets, you put too much pressure on your assets to support your lifestyle. I mean, it could be frightening. Put it that way. It could really be frightening.
No, 100%.
And I don't want to scare the audience, but like the reality of the fact is, we've heard about the 4% rule, right? If you have $1 million, you could be able to
throw it out the window.
Throw it out the window. $1 million supports $40,000 pre-tax. Yeah, I mean that all sounds safe and that all sounds nice, right? But the downside to it is, we've seen market volatility. If you're $1 million the first year you retire, we enter a year like 2022, market's down 20%. Now your $1 million is $800,000, and you're taking $40,000. Well, that's no longer 4%. What's that? That's like what, 20%? Yeah, a 20% withdrawal.
And you're not taking less. Like, I mean, that's the truth is.
That's 5% withdrawal, not 20%.
You got it. You got it. Okay. I was thinking about something you said, and I was going to expand on it, but yeah, to your point though, is when individuals have this lifestyle, the reality is they don't ever typically spend less. Okay, so when you enter retirement, the experience that our clients have is the lifestyle that they are living, especially in those first few years of retirement, the distributions that they're receiving. If the markets do correct, or if they experience volatility, which they will, because it's going to happen, because it always has happened, the reality is they're not taking less money in those moments most often.
Yeah.
Okay. So the question is the dollar changing? Is currency in and of itself changing? We saw gold.
Oh, yeah.
Silver, maybe a little late for silver, but we saw gold take a massive run. And I think for just the general population, when they see something like that, they think, oh, safety, security, U.S. dollars falling, I think it's the question we have to answer. Is the U.S. dollar changing? Is currency in and of itself changing? And if it is, what does that mean to individuals that are trying to literally make the final steps toward retirement? And then, of course, we won't maybe get into it today, but just the whole concept of maybe a completely different way of exchanging money back and forth, which is all these new ideas. Well, I say new, they're not new as of now, but the concepts of like cryptocurrency, et cetera. So what's your thoughts on that? I mean, when it comes to
the dollar,
the change, or just the change in general of currency?
Yeah. That's a good question. So like the dollar itself, it still remains the world's most primary reserve. The dollar, for lack of a better words, is, in my opinion, is still the gold standard.
Yeah.
Companies, even if the dollar fails, the amount of global trade that happens based off of the dollar, I mean, it's astronomical.
Global
right?
trade in general is
Right.
heavily influenced
by the dollar.
by the dollar.
And so call me being naive, call me being a patriot, call me being whatever it is, right? But I feel very adamant that the U.S. dollar is still the strongest currency in the world.
Yeah.
That's just the way I feel. But yeah, the value of it has changed, and it almost comes to a point where, again, I'm not an economist. I'll just maybe talk of the way Main Street looks at it. But it almost feels like it doesn't even matter what the dollar does. In some aspects, if you could follow me here, it's just like we just need to be able to support the lifestyle that we want, and the value of the dollar is going to consistently change. As far as the value, meaning like what the purchasing power is always going to consistently change. Our responsibility is just to make sure that we can just continue to catch up with it. If that makes any sense, but
well, I think
does it make sense?
Yeah, and the reality is like an economic system that we have had for decades and decades and decades. Okay, so for a long time, has operated under the substantiated value and the foundation of the value of the U.S. dollar. Right. That doesn't fall in a day. Okay, so I think some of the voices and the noise that's out there, and there's a lot of it right now, especially that's like, hey, U.S. dollar, there's a lot of concern. That's why gold's rising, currency's changing, U.S. dollar's going away. Okay, it's not happening in a day, right? The global economy in its majority in trade has found its way back to the balance of the U.S. dollar. That's just the reality of it, okay? And when you look at the world economy, the setup has always been, countries producing, manufacturing goods and services, selling them, and then a lot of the proceeds and the assets are then held back in something that's backed by the U.S. dollar, okay? And so you got this system that's been around for quite some time. Now, obviously, there's seasons and moments where that fluctuates, right? Mm-hmm. The U.S. dollar in its value compared to other currencies, that's always a conversation, always has been. And so, there's always this balancing act. And of course, it's much deeper when it comes to, U.S. security, U.S. debt, U.S. Treasury, et cetera. What I think is interesting, though, is at least since I've been a kid, a lot of this global trade structure I feel like it's changing. Even since, growing up until the current moment, we've always been in this like setup economically, which I think it impacts the U.S. dollar, but we've always been set up economically where we basically we Americans build manufacturing outside of the U.S. to produce goods and services to then sell, right? And we sell them globally. Well, with the new administration, which is vastly different than I think anything I can ever recall, is this concept of making now, basically turning the table, like flipping it. Okay, so now we're making, in some sense, forcing, right? Incentivizing, I guess I should say, international organizations and companies to come to the U.S., which is different, to manufacture, produce goods and services than to sell them globally. So instead of us always going out for cheap labor, we're now incentivizing in a way for countries and companies ultimately to come in, right? And so I think like, what does that mean, to the U.S. dollar? I know what it means. I can think about what it means to the U.S. economy. Obviously, that's going to take time. That's not something that happens overnight. It may not even be something that we really see the fruits of in this administration. So long as there's an incentivization for these companies to do this and to come here to the U.S., to build, which obviously there's plenty of data and facts that show that's happening right now. But it may be 5 years, 8 years, 10 years before we actually see the fruits of that. But the reality is if they're here producing goods and services, and we as economy are operating on the U.S. dollar, then the production of goods here shipped out to sell to the world is only going to sustain the viability of the U.S. dollar over time.
Mm-hmm.
Now, I know you may disagree with that some, because I know you and I both share a similar outlook, but then also some different outlooks when it comes to like commodities and some staples when it comes to like gold and stuff like that. Yeah. But I don't know. What's your take on that?
No, I think that makes sense. I mean, it's definitely a shift. It's a change in our lives, in our lifetime. We're both, we've gone through the same administrations through our lifetime, and this is completely different. And for me, I think that really will strengthen what the dollar is, because all of a sudden it's like manufacturing's here. Hopefully that brings a little more strength, a little more employment, a lot more employment here to the U.S. We have a lot of resources here in the U.S. We have a lot of land that needs to be developed and could bring in that could be used to develop and produce, and we can become one of the biggest exporters out there to other countries. And so I think that is, personally, I believe that that's the right way to go, and to boost the U.S. dollar, and as opposed to infusing it with as opposed to infusing the economy with fake money that's being printed. Now we can infuse the economy with money that's actually being collected, money that's actually being produced by, manufacturing and sales, and maybe some tariffs that we've seen right now, like injecting the economy with real money, not just printed money. So I think I think over time the value of the dollar will continue to rise. I think that the instability we're seeing right now is just because it's a change, right? Whenever you're going to make a massive change like that, I mean, like you said, over our lives, over just our lifetime. So I'm 44, so we're talking over the last almost half a century, where institutions and the way monetary policies have been constructed. This administration now is trying to rip that entire foundation. So of course things are going to feel a little different, right?
Well, and there's been a massive change in how the government has even played around this scenario when it comes to currency and the diversification and the changes. I want to read you this real quick. So this is coming from 2025 Q3 from a report. Total foreign exchange reserves around 13 trillion, and the dollar share at 56.92%, proving that obviously it's still dominant, but the diversification is quite real. Now, the big conversation has been this, and this is this whole shifting you're talking about. Like, it's real, but is it, does it prove any evidence that we should panic? Central banks buying gold, okay?
Okay.
Now, they have definitely made a very, what I would say, profound stance in their purchasing of gold over the past, 8 months, 10 months, something like that. And now, when you see literally the government do that and central banks do that, then of course it's like, I feel like they're taking the lead, right?
Yeah.
But for retirees, I think the message from our perspective is ultimately, when you see that, it's not a moment to panic, it's a moment to diversify. Because the reality is that's what they're doing in their world and in their game, right? They are taking a stance to, and you see this shift happen, whether it's, banks buying debt, banks releasing capital, banks purchasing, foreign currency or foreign debt or whatever it may be. You see this rotation of asset. And I always like to say, keep it simple. The reality is money chases yield, period, right? Wherever it's at. And so when gold is, appealing because the yield is reasonable relative to risk, that's where it's going to run.
Yeah.
And so as a consumer, as a retiree, as someone who is like, hey, I've saved, once again, $4 or $5 million in assets. I'm in a good spot. My biggest fear is, what if it means nothing? Like,
That's a big
what?
fear,
Yeah, right. That's a big fear.
Yeah.
So the answer is don't panic, but should you diversify here, just like some of these banks are?
Yeah. Yeah, and diversification is huge. I mean, like, you really have to start thinking about what type of diversification. You know, one way of diversifying is different asset classes, right? So you may have stocks, bonds. Okay, now I want to add some commodities, which is, gold, silver, whatever it may be. Okay, I want to diversify, and I want to get some real estate, whether it's rental property, whether it's just don't do data centers, because you got to be exploring data centers in space. We can talk about that later. But diversification and asset classes, right? You could be diversification. Okay, well, the U.S. Over the last 10, 12, 15 years, the domestic markets have been crushing it. So, but last year we saw a rise in emerging markets and international. So maybe I should diversify and maybe look at global assets to invest in. So those are two forms of diversification. I think over time we need to diversify as far as the way tax diversification. Retirees need to look at where they're pulling their money from. There should be taxable accounts. There should be tax deferred accounts. There should be tax free accounts, Roth accounts. Yield, right? I mean, there could be some assets that you're diversifying that are stable, that are going to just provide you income, and there's some that are going to provide you the growth down the road. Annuities, right? Should I have an annuity in my portfolio? Well, the value of an annuity is that you get guaranteed income for the rest of your life to help support the foundation of your income. So I think what retirees really need to look at is, what type of diversification should I really be putting into my plan? Because I think when you say diversification, I think the majority of people think the mixture between stock and bonds.
That's exactly right.
60-40. Okay, everybody keeps talking about the 60-40 portfolio. I need to have 60% in stocks or equities, 40% in fixed income bonds. That's my diversification. So Andrew, when you say diversification, what level? 70-30, 90-10, 80-20, 50-50? That's one level of diversification. But the reality is, you need to really broaden your idea of diversification, because there's so many levers that could be played and pulled and tugged upon during our lifestyle when it comes to our money, that your plan needs to be flexible enough. And so a lot of what we do for our clients is really lay out those cards, right? And you want to have a hand in every single one of those buckets. Each person is different of how much we emphasize one over another, but you point me out a client of ours that doesn't have those cards being put inside of their plans. There isn't one. Yeah. All of them have some form of that in their plan, because it just makes total sense. Yeah.
No, what you're saying about diversification, it does make total sense. And the reality is when you see a country that's running on debt, they have to make choices. There are only very few, actually, long-run choices that I think they can make, and it's all about this diversification conversation. They have the choice to increase taxes. They have the choice to, basically inflate and run away from the responsibility of the debt, which would be dramatic. And a lot of their choices, though, affect the American people and affect the U.S. dollar and affect lifestyle. So to your point, I guess where I was trying to come back full circle here is, you're talking about diversification in all different areas of your plan, not just stocks and bonds. Well, when you look at where the administration is and you look at the decisions they've made with, putting reserves over toward gold, and you look at the next potential administration, if it is not similar in line, like from their outlook on how to address taxes, et cetera, the reality is the environment that we're in right now will dramatically change. And so when that changes, diversification is going to be what sets you up right. So the decisions you make today from an individual planning standpoint, to your point, should I diversify in how I'm structured from a tax perspective, is now a better time to deploy tax strategy, so that I'm diversified in a way that's going to help me handle potential uncertainty on the tax environment later in life. Mm-hmm. All that matters. In retirement and at retirement, and our firm is like pro returns, right? Mm-hmm. Like this whole, we want our clients to see really nice returns in exchange for the risk that they're taking. But in retirement, for sure, the number one priority is not maximize performance. The number one priority is avoid a major loss at the wrong time and in the wrong area of your plan.
It's almost like maximizing stability.
Maximizing stability. And that comes with performance.
Yeah, right.
Maximizing stability comes with obviously creating solid, great earnings. And I basically, reject our industry's voice on, hey, you need to be ultra conservative.
Oh, that's so
right?
stupid.
It's absolutely, but
It
it goes
really
back to this whole U.S. dollar thing. I mean, even like obviously being an independent firm, right? We can do anything for our clients, right? We manage our own assets. We're fully independent, licensed with the SEC, and I don't say that as like a sales plug. I say it that we're not handcuffed to the broker-dealer world. We're not handcuffed to an insurance company or some FMO company or whatever it may be, which if you're listening to this show, you probably don't even know, but the majority of advisors are actually, handcuffed to a hierarchy. And if you read all the disclosures at the bottom, you'll find that. Well, we're not that, right? We're directly licensed with the SEC. We're free truly to do what's best for our clients. I say all that to say, we don't really have this stance that like any particular investment is like super negative, right? Mm-hmm. Our whole thought process is how does our client win? What's the best process and the best road and pathway to take for them to win? We educate. We find the right fit that they like, that we think is going to work best based off of a lot of different elements, and then we execute. I say all that to say this. Where was I going with that? I was going somewhere great. Oh my gosh. Okay. No. I told you earlier, right? It was like live. Okay, I can't remember. But my point is this.
You're on a roll, though. You are on a roll.
I know. I was about to bring that home with a slam dunk. Okay, but in all honesty, I think I'll just try to fix where I was going. The whole idea here is planning is what's going to set you up for success.
Yes.
Okay? Diversification matters.
Yes.
Having a active, living, breathing plan matters.
Yes.
The whole idea that you should be reducing risk is not the innate, like not the finite goal. That's stupid. Mm-hmm. Okay? If your strategy literally right now is wrapped up in a target date fund, like go schedule an appointment with somebody.
Yeah.
Okay? I mean, obviously we love you schedule schedule it with somebody. Mm-hmm. Okay, that's silly. If all of your money is left in old 401ks and in a target date fund, it's stupid.
Yeah, what are you doing?
It's dumb.
What are you doing there?
Yeah. If all of your money is wrapped up in CDs because, well, I'd just rather do it myself or I'm nervous. Stupid. Dumb. Not a great decision. Why? Because everything is outpacing the value of your money. Your money's not working enough to keep up to support the increased cost of goods. Goods are not coming down.
Yeah.
Right? The cost of goods, which is such a political propagandized referenced word right now, which is affordability, right? The affordability problem happened years ago, okay? Mm-hmm. Which, out of all grace and kindness, the reality is we went through a time that was very challenging with the pandemic, right? But the reality is, once again, you dilute the currency, you throw a ton of money into the economy, you create fake wealth, it's not real, you drive inflation up, price of goods go up. The problem is wages didn't quite keep up with that, and the reality is we have goods that are expensive. They're not falling. Okay? The demand is still there relative to the supply. It's not going down. So the point is if you don't have your money structured correctly with a respect toward risk, but also respect toward loss, you're never going to survive. And it matters more now than I think it ever has. Because things are changing.
Things are changing, yeah. Yeah, I mean, like, you hit it right. You hit the nail right on the head, man. This idea that your age determines the risk level you should take is absolutely a fallacy. The idea that at some point, sooner or later, affordability is going to be, we're going to fix affordability just like that. That's not going to, prices are going to go down. I'm still waiting, and it's not happening. Right, it's just not happening. We've entered a new normal, And that's the reality. I think at the end of the day, that's the reality that our listeners need to understand. We're in a new normal right now, and you have to adjust to that. So the idea of, I'm 70 years old, I need to run to my bank and get the best CD right now that's paying 2%. Well, that's good for you, but that's not doing anything. You've just lost, maybe 2% of your money because inflation and the cost of living has gone up at that pace.
Yeah.
So it's not about it's not about an idea of your age determines your risk. It really is what is the necessary balance between what you have versus how much you need, and what's that pressure point. And if you understand that, if you got $2 million and you're saying to yourself, between my Social Security, between my pension, between my spouse's Social Security as well, we only need to take 20 grand from our $2 million to support our lifestyle. Well, then you can take risk. If 20 grand is all you need from your assets of $2 million, yeah, you can. You don't have to, right? But you have the luxury to take on risk, right? But if you've got $2 million and after speaking with, the both of us, and you're like, well, Mo, well, Andrew, we got $2 million, but I probably need, $75,000 a year from this $2 million to live off of. Well, you're putting a lot of pressure on those assets. Mm-hmm. Like you need $75,000 on top of all your other income plans. Income streams.
Yeah, your burn rate.
Your burn rate is high.
Right.
You may not be able to afford that type of risk.
But in their defense, back's going to be, yeah, but Mo, I've earned 15% last year. I earned 20. And the reality is right. You have. Right, which is why you've probably been a little bit more generous with bumping up that distribution rate. So now that burn rate is at 75 grand, where maybe last year was at 50, the year before was like 45. Mm-hmm. Now you're at 75, and what happens if the tables turn on you? Look, I think the way I would end this is this: if you are near retirement or you're in retirement, okay, you have done all the hard work. I mean, literally grinded it out 20, 30, 40 years of your life, right? Do not, for God's sake, please, do not do nothing, whether that means leaving your money on the sideline or leaving your money all at risk in large cap US Act because it's done great over the last decade. And you think, shoot, it's created my wealth, I'm going to stick with it, right? Don't have the mindset of doing nothing. Okay? And don't lose track that whatever you do own, the value of the currency that's used to own what you own is also a living, breathing item that you need to wrap your mind around. And if you can't, you're plan better so that your ability to live the lifestyle that you're living and sustaining, I like the word you use, stability, sustaining that lifestyle consistently year over year over year in the uncertainty of your own life, the uncertainty of our economy, the uncertainty of our currency and our politics, etc. You better make sure you have thought through or had somebody that's been able to think through the structure and is literally a living, breathing driver of your plan.
I love that. It's a great way to end it.
Yeah, and I'm gonna promote a video that we got coming out here too because I think it's important. So don't forget, we also, Mo and I both release a lot of just heavy educational content. It's like for everybody, right? Just different topics, different times, but this the conversation we're having today about the U.S. dollar and how it relates to the old million versus the new millionaire, et cetera. We have a video coming out that really is about the value of your dollar and the change over time. So if you want more details, more facts, more data about that, go check out that educational video. Apart from that, Mo, you want to close us out?
Yeah. Thanks again. Like, subscribe, share the content, and check out our old videos. We do a lot about retirement planning, income planning, distributions, taxes, and financial planning overall. So thanks again, and we'll see you next week.